Today is May 25th, 2025, week 2 as a value investor. So we'll dive right into it. 12 silliest things people say about stock prices, as covered in the book I just finished up this past week, One Up on Wall Street. Number 1. If it's gone down this much already, it can't go much lower. Peter Lynch goes on to give us a case study on how Polaroid hit an all-time high of 143 before it started crashing. At the time, it was considered to be a highly reputable blue chip stock, but due to declining sales, it sank from 143 to 14, all the while people would buy at all points of its decline, thinking that it couldn't drop any further. Number 2. You can always tell when a stock has hit rock bottom. I'll give this one out word for word because he explains it better than I. Bottom fishing is a popular investor pastime, but it's usually the fisherman who gets hooked. Trying to catch the bottom on a falling stock is like trying to catch a falling knife. It's normally a good idea to wait until the knife hits the ground and sticks, then vibrates for a while and settles down before you try to grab it. Grabbing a rapidly falling stock results in painful surprises because inevitably you grab it in the wrong place. Number 3. If it's gone this high already, how can it possibly go higher? Again, Peter Lynch provides another case study where Philip Morris was trading for $1 in the 1950s and by the 1980s was trading for $1.30. All along the way, anybody could have locked in their profits, not knowing that they were exiting on a great stock and opportunity. He then reminds the reader to pay attention to the fundamentals of the companies you're investing and proceeds to say how there is no rule that a company can't go higher after years and years of absurd growth. Number 4. It's only $3 a share. What can I lose? How many times have you heard someone say this? Because you said it yourself. You come across some stock that sells for $3 a share and already you're thinking it's a lot safer than buying a $50 stock. Peter Lynch proceeds to say that it's taken him 20 years to finally realize this. It doesn't matter if it's a lousy stock at $1 or a lousy stock at $50. Focus on good companies regardless of stock price. Number 5. Eventually they always come back. He proceeds to highly disagree with this mentality, stating that he personally has seen conglomerations rise and fall in his lifetime. Number 6. It's always darkest before the dawn. There's a very human tendency to believe that things that have gotten a little bad can't get any worse. Peter Lynch proceeds to provide a case study. In 1981, there were 4,520 active oil drilling rigs in the U.S. And by 1984, just 3 years later, the number had fallen to 2,200. At that point, many people bought oil service stocks, believing that the worst was over. But 2 years after that, there were only 686 active rigs, and today there are still fewer than 1,000. Number 7. When it rebounds to $10, I'll sell. He proceeds to mention that in his experience, no downtrodden stock ever returns to the level at which you'd like to sell. In fact, the minute you say, if it gets back to $10, I'll sell, you probably doomed the stock to several years of teetering around just below $9.75 before it keels over to $4. Number 8. What? Me worry? Conservative stocks don't fluctuate much. 2 generations of investors grew up on the idea that you can't go wrong with utility stocks. You could put these worry-free issues in the safety deposit box and cash the dividend checks. Then suddenly there were nuclear problems, rate-based problems, and then stocks such as Consolidated Edison lost 80% of their value. Then just as suddenly, Con Edison had gained back more than it had, proving that utility stocks are just as volatile as regular stocks. Number 9. It's taking too long for anything to happen. He proceeds to explain that if you give up on a stock before you're tired of waiting for something wonderful to happen, then something will begin to happen the day after you get rid of it. Number 10. Look at all the money I've lost. I didn't buy it. Peter Lynch proceeds to preach about not downing yourself for not executing a trade correctly or for not holding a certain stock longer knowing how much money you would have made. You cannot change the past. Number 11. I missed that one. I'll catch the next one. He proceeds to give various illustrations proving the next one rarely ever happens. The next McDonald's, the next Tesla, the next Amazon. You will not be able to tell if a company will be the big one. Choose good companies, and I'm sure one of them will be something special. Number 12. The stock's gone up so much, I must be right. Or the stock's gone down, so I must be wrong. Peter Lynch goes on to explain that small price movements is just the daily, weekly, or even monthly goings on of the market, and generally should be ignored. As long as you focus on important fundamentals, you'll make money in the long run. So, this past week, there hasn't been anything notable going on in the market, and no new changes to my holdings other than a sixth position I opened up called YMAX, one of the largest dividend stocks I've ever seen at 60% dividend yield, paying at a weekly basis. Thank you for all your patience, and please subscribe.